Good afternoon. Peter Klein, Chief Investment Officer, Founder, ALINE Wealth. We're here today to speak about financial manias, a little history lesson, folks, and I thought it was apropos given where we are today in the environment and the markets. The question I ask is, are we learning from the lessons? As you'll see in front of you, we have a deck of slides to share with you. So let us proceed. The first up is, the sort of thinking that there have been booms and busts along the way and for hundreds of years of financial history. And the spark that often starts these periods are very similar, right? So the story that subsumes logic, that sucks in investors in of all types and stripes, government policies that help fuel the bubble, right? Bigger than life CEOs or strategists or entrepreneurs that are out there that make over-the-top projections. You've seen this before. You've heard this before. The feedback loop that continues to fuel the bubble until something gives. The music stops. An exogenous shock brings investors' mindsets back to the what if. And this is what we're speaking about today. I'm not suggesting that we're in a bubble. I'm suggesting that we're bubbling and things are getting to be in that place that gets us a little worried these days. Okay, next slide. Well, it goes back to the 1600s and TULIP mania. Now, this is before the modern day, markets and stocks and bonds and that kind of financial market. So this is when they were trading, I guess, seeds and bulbs. But you know the story about the TULIP mania. You know how it ended, and it was a short period of 6 to 12 months, and then boom. Then we go into the South Sea bubble, and part of this talk today is due to a book by Mr. Levinson, who is writing a book about the South Sea bubble and about manias. Very interesting read. And so we talks in there in the book about Sir Isaac Newton, the greatest mathematician of his time, the smartest man in that 1720 period, and how initially Newton, sort of saw the handwriting on the wall with respect to the South Sea bubble, and invests a little bit, makes some money, gets out, is all good with it. He's a very conservative investor, has a considerable sum, is happy with his return, all good. Until he starts seeing his friends get richer and richer. And then he comes back in. He makes the fatal error of getting back in. And while it goes a little higher, it plummets down months later. And by Christmas 1720, he has considerable losses. And his niece was on record as saying that Sir Isaac had said that he could understand and measure the motions of the stars and the heavenly bodies, but it's the madness of people that he has trouble with. And that's sort of the key issue here. In the end of the day, markets are essentially that of people, right? Everyone doing something together. More demand, increases prices. And there have been book upon books about, study upon study about this mania kind of aspect. So we look at the Roaring 20s, and now we're in the 1900s, modern day, and you see here how it took 25 years for the Dow Jones to get back to 1929 levels, and the Roaring 20s, the great Gatsby and all that was involved there. And interestingly, that comes on the heels of the Spanish flu, of the major epidemic pandemic of earlier 100 years ago. So it's interesting context there in post-World War I. Then we have, I guess in the 80s, the Japanese asset bubble. You may remember how Japan had essentially owned, a lot of the real estate in New York City, and how they were purchasing that land at inflated prices. But you can see the Nikkei index here topping out. It's at 1990, and it's just been 2 decades of pain. And so, lessons learned there may be much to do with governance and the policies that they had at the time, but it also has to do with this notion of, continuing buying and buying and having the asset bubbles of land go higher and higher. We have the stock plunge of 1987. That's when, by the way, I started in this business a year prior to that. And I recall it was right after my birthday in October that this occurred. I had just signed the lease with a college buddy on an apartment in Manhattan. And, we were working and going to school, grad school at night and just working and working. And then this happens. And I often felt, I remember at the time, like, you work so hard, you try to do the right thing, you try to study and understand the science of finance, and you put all your effort into, servicing your clients and working really hard. And then all of a sudden this happens, and I recall feeling like, oh boy, I guess I got to look for a new profession. Well, happily, 30 years later, I'm still here. This particular bubble, I think you could describe it as that, had a lot to do with this notion at the time of portfolio insurance, using derivatives and derivative policies for that. And many times that is, often what happens. Something new comes into play, and that's something new, affects what we're looking at in the in the marketplace. So we'll see. Perhaps there are some things that are happening today that are new. Stay tuned. Next up is the dot-com bubble. Many of our listeners will remember this one as it is in most recent memory, perhaps 20 years ago. And you recall back then how it was the new world, a new era, technology, the internet, clicks rather than earnings. And how stocks were just going up day after day, essentially year after year for a few years there, until they weren't. And it's taken 16.6 years, it looks like, to get back to where that composite index was. And of course, it's taken off again in the last year or so. Although I will say the earnings picture is a lot different today for these tech stocks as it was versus then. However, in the same voice, I'll say there are many tech stocks today that still don't have earnings. Those are not the largest players in the index. Then we have the housing bubble of 2008. Prior to that, by the way, in 1997, going back to 98 rather, going back to Sir Isaac Newton, the brilliant mathematician, the genius. How can he go wrong? I recall the long-term capital management debacle of the fall of 1998. It was a short little, it didn't last as long as many other pops or bubbles. Or the thing there was, hey, you got these great mathematicians, these PhDs, these brilliant folks, and they're doing a special fund, and how can you lose with such brilliant people behind you? And so, there was a fair amount of bailout that occurred back then. So I think of Newton, I think of that, but I digress. Back to the housing bubble. And indeed it was. And this notion that the government has a hand in these things, right? Think about, what was the Community Reinvestment Act, right? CRA, back in perhaps maybe late 2000, late 90s, early 2000s, whereby banks were told that they should be using, they should lengthen their mortgage sort of thinking and increase the accessibility to folks to have mortgages, which sounds nice until you get ninja loans, right? That's sort of what happens when you go too far. Remember the pendulum. Markets will swing to the excesses. So now you have folks that are having mortgages that have no income and no job, and they got this nice house they can't pay for. They have no idea what a mortgage is, let alone how to pay for it. So this is what happens in capitalism. This is what happens in markets. Things go to excesses, hence bubbles. So now today's bubbles, the all-powerful Fed and the global central bankers. Perhaps that's the next bubble, right? The fact that, hey, you can't fight the Fed. Whatever the Fed is doing is the right thing. They're inflating an asset bubble by keeping rates as low, at buying bonds and who knows what next, and Bank of Japan buying stocks and ETFs. Who knows what that means and how will that work itself out? the power of low, even negative around the world, interest rates, and how that TINA-ized, that's a word, I coined it, TINA-ized the markets, where now, because of the low or no interest rate environment, folks have to reach for return, have to go up the ladder of risk and look for higher risky investments so that they can achieve a return. And what does that do? That puts, and then again, if everybody's doing it, it's working. So now the guy who says, oh, okay, it's working, and now I'll do more. Oh, yeah, maybe we'll margin. Oh, maybe I'll go further. Oh, you see what happened? That's the nature of crowds, nature of people. This is what happens, the madness of people, like Sir Isaac had said. The concentration of indices, you've heard about this. S&P 500, 5 stocks, 25% of the interest of the index. That kind of concentration is bubbly in my book. The passive indexing revolution that we've seen over the last 10 years, 15 years, that's a bit of a self-fulfilling prophecy, because the more money goes into the indices because of passive management, okay, great, sounds good, makes sense, until, because they're cap weighted, you've got to buy more and more of the top cap weighted stocks, which then go up higher and higher, which then makes the index go up higher and higher, which then attracts more money. You could see the situation, what I'm saying here. It gets inflated. It's a self-fulfilling prophecy. What happens when it unwinds? Who's the buyer? Okay? Valuations clearly stretched, clearly not what we expect. If you look at the every valuation metric you can look at, they're all above their historic long-term averages by a considerable amount. Yeah, maybe it's a new world order. Maybe this time is different. Dangerous words. But, I can understand where that, maybe things are a little bit, but is this much? That's the question. And the belief in tech stocks and how they're impervious to all threats of fundamental competition and new product cycles and the law of large numbers. How large can these addressable markets be? There are a finite number of people in the world. So it gets to a point where you start worrying about these kinds of things. Color me as one of those worriers. But it makes sense in my book because, as a steward, as someone there to protect our clients' interests, we're always thinking about what the next issue might be, what the next problem, where it may come from. Because in the end of the day, we're there to focus on you. That's what we do at ALINE Wealth. We put clients first and second and third. Thanks for listening. Have a great day.